This is Mira Business FM. The show is The Morning Drive. My name's Tim Elliott. Thank you for joining us. If you're with us on YouTube, stay with us there. You can also watch back on YouTube, of course, and on all the usual social media platforms. You'll find us on Instagram. All you need to do is search Mira, M-I-R-A, Business FM. Should come up wherever you do your searching. That's how you do it. You know where I'm going with all of this. info@mira.fm is the email address, and also whatsapp.mira.fm will bring up the WhatsApp number to get in touch directly to ask any questions or to let us know what you think. Give us a like and a thumbs up. That's always appreciated. Now, James Thomas is here. He's an independent financial consultant. Nice to see you. It's very good to have you here, James.
Yeah, it's great to see you too.
The pregnant pause there was not me. It was not James either.
No, I was waiting for a red light.
You, not the first time you've said that. Anyway,
Let's not go there.
This morning has been a busy morning. We got through, by way of introduction, we got through a number of financial terms last week that we're supposed to really understand as adults in the modern world.
Yeah, I mean...
Kind of.
Be aware of.
Okay. The reason was that last week I was talking brokerages with Mazammel on this show, and getting your head around your financial life is kind of difficult. There are lots of phrases to learn. There are a lot of technicalities to understand if you're going to take charge of, for want of a better phrase, your financial destiny. And it's something we all have to do.
We do, yes, more and more so. Falls on our own shoulders. There's no one else, no big brother, no... very unlikely that someone else is going to take care of you.
Yeah, and very unlikely that somebody's going to leave you enough money to live on for the rest of your life. So you have to make those decisions, don't you? And that's really what this segment is all about. But then you have to deal with all the phraseology, the acronyms, I don't know, CFDs, the terminology. It's like joining a club. That's what we were talking about last week. Some of it's kind of inscrutable in a lot of ways. So to cut through that, what I thought we'd do is... run through approximately 30. We got through, I think, 12 or 15 last week to kind of define, to discuss, to demystify the 3 Ds of financial vocabulary. I've got there in the end. So here's where we were, James. Let me just run through the list. We talked about credit scores. We talked about capital budgets. Debt-to-income ratio, which was fascinating. We talked about equity. We talked about hedge funds. We got to investment. That was the next word that came up, and kind of an important word. We all think we know what it is, but how would you define it?
Wow, so investment, that's probably one of the biggest terms we've come across.
It really is.
I mean, it's such a wide...
It's a good place to start.
It is. How would I define investment? Using some money for your benefit.
Pretty good. I mean, I've got one here, and it's almost exactly that. Allocating resources, time, money, or effort, but in this case, money, because we're talking finance, in the hope of gaining benefits in the future.
Yes.
That's really what investment is. Planting a tree in your backyard, expecting shade and fruit, is a simple kind of investment.
I use it all the time, very cheesy, but when's the best time to plant a tree? 30 years ago. When's the second best time? Today.
Exactly.
You know, if time has passed and you haven't made a plan, it's still
time to make a plan.
Time to make a plan.
Right.
Get that seedling planted, or that seed planted, to get the sapling growing, get the tree, because before you know it, the tree has arrived.
Yeah, okay.
Time passes so fast, as
and
we've
you've got
discussed.
fruit and shade, as we said.
Okay. Very cheesy, but that's the reality. That's a great analogy.
It's a good way to start the conversation again today, I think.
Yes.
In theory, it's a very simple thing, but it's something that, not all of us do particularly successfully. Let's be honest. The next one, we're moving in alphabetical order, of course, is leverage. People talk about leverage in lots of different ways. In financial terms, I'll ask you in a sec, but leverage is, I've got leverage over you, got something on you, sort of thing. But
in finance, absolutely,
in financial
kind of the
same thing.
It is a bank, a building society, a lender.
Yep.
Because leverage is to borrow, effectively.
Yep.
So it's that someone has got something over you, that you have taken something from them legitimately, not stolen.
They expect it
but
back.
they're expecting it back, plus some benefit to them for the pleasure of having lent that to you.
Yeah. It kind of amplifies the potential returns and risks of an investment, I guess.
Yes. Why have they lent you that money? Very unlikely it's from the goodness of their heart.
Yeah. Okay.
They were expecting a return, a benefit for that transaction.
Okay, that's leverage. A mortgage. Years ago, before, as Freehold Property was launched here, I worked for a financial magazine, and the editor and I went to some of the early property sales, property centres, the sales centres, some of the really early real estate
models and
amazing, and some of the models were amazing, just incredible to look at. And we sat and asked questions for a magazine article about, what was being offered and everything else. Not in an underhand way, just to try and get a grip on what was going on, because it was a very small market in those days. This was 2000, I guess around 2003.
Yep.
And one of the things was we sat with somebody selling properties and we said, well, so what are the mortgage, what kind of mortgage offers do you have? What are the opportunities available? And one of the responses, I kid you not, was, what's a mortgage? It was obviously a very new concept at that time, and that particular person wasn't really au fait with everything, new hire and everything else. But that's the question I'm going to ask you now. What's a mortgage?
Well, a mortgage is again another form of loan. Now, I'm just racking my brain to remember what it really stands for, but it's a death. The mort is obviously death.
Yeah, well, it comes from the French, I guess.
French, yes.
Yeah. I wasn't expecting you to translate it, but if you can, bonus points.
No, my mind has gone blank. But why a lot of has been referred to or reminded people of, because it is, if you're not careful, it can be a very tough thing to have attached to you, if that's the right word.
No, because, I'm with you. It's a
but to rewind the first point, what is a mortgage? It's a loan upon an asset.
Yes.
So it's asset-backed loan. But
generally, a property.
Generally, a property. In this country,
most cases,
cars are also financed in the same way that the vehicle, whereas in other countries, even though it might be called a car loan, it's not secured against the car. But as an aside, but yes, generally it's a property of some description. So again, not from the goodness of their heart, they are lending you that money in expectation of a return. Generally, that return is lower, which is why most people like mortgage debt, or it's perceived to be a better form of debt, but with the caveat that it's generally for a much longer term.
Sure.
So the flip side is that you're paying that lower rate of interest, but for a much, much, much longer period of time. A car loan, maybe 3, 4, 5 years. A mortgage,
15, 20,
25. Even in the UK, they're pushing out to 30 years.
Really? Okay.
So even though that may be, for argument's sake, 4%, whereas the car loan may be 6 or 8%, but the car's done and dusted in that 3 to 5 year period, you're paying this for 20 years or so, and obviously therefore paying the institution a much, much bigger amount of money over that period of time. And just to remember, they have what's called first charge over that property. So therefore they effectively own it, and you're paying for the pleasure of using it for that period of time until such time as you've cleared the debt. The ownership transfers in its entirety back to you.
Do you know what's interesting about the mortgage arrangement, about any financial arrangement with any financial institution is, and I think it's often overlooked, but it's particularly true with the mortgage, is that it's a financial product. It is an investment. It is obviously a liability in some ways, or potentially. But it's also a relationship that you build. And I don't think people think of it in those terms. You have a financial relationship with your bank, and you may also have a personal relationship with the person within that bank in some cases. But it's very often the start of what is quite a long-term, or part of a long-term relationship. Kind of important to see that.
It's very important to see, and perhaps has become less so in recent times.
Yeah, probably.
Because certainly our parents' era, they would have opened a bank account.
They would know the bank manager.
And they'd know the bank manager. And then when they'd got married, they'd go to see that bank manager and say, right, we wish to buy a property. That bank manager would have had the autonomy or the authority to lend them that money, having assessed the income that they're earning. And they would probably have remained a client of that bank for their entire life,
In many cases, I think that's true.
regardless of whether that mortgage product was good, bad, or indifferent.
Yes.
Rightly or wrongly, probably rightly, it has made the industry a lot more competitive because more institutions have entered that market, and therefore people look for the best offer, the best deals. So that relationship is probably the part of the scenario that is weakened, because you will potentially jump to different institutions to secure the better rate.
Sure.
Rather than in the past, perhaps you would have gone to that bank manager that sadly probably doesn't exist anymore and said to them, well, actually, ABC down the road have offered me this, and you could have had a conversation, and they would probably, again, had the authority to say, okay, we can't match that, but we can do this for you. And as we know, most people are creatures of habit. The thought and of the hassle of moving all of their financial affairs.
Yeah, it's easier to keep them
It's just
in
easy to
one place. Sure.
keep it in one place.
Yeah.
Absolutely.
Okay, but it's worth remembering, I think, and I kind of think it's very important that you do have a relationship, and you can leverage a term that we now understand, that relationship to say, look, I have this product with you. I'd like to do this. If you decide to,
Absolutely. I mean, that's another useful interpretation of that word. Absolutely, because you have, as the customer, the client of that institution, shown your loyalty, so you're going to leverage that relationship potentially for other means or benefits to yourself.
Two for the price of one today in terms of leverage, isn't it? So let's move on from mortgages, but simply a loan specifically, generally for purchasing a property, but a loan that is secured against an asset.
Secured against an asset.
Okay. Mutual funds. What is a mutual fund?
Again, very broad brush term. But a mutual fund is often called a unit trust, an OIC, which I love, an open-ended investment company, an investment trust.
I love the OIC. To anybody that wonders why OIC is funny, an OIC is an old English term for a ruffian, a thug. But it's kind of a nice ruffian.
Nice ruffian.
Oh, you're such an oik. I would call you an oik over a cup of coffee, James. Yeah.
Thank you.
Sorry, I butted in.
But a mutual fund is, again, a collective of shares, stocks, generally, pulled together to become a mutual fund that then many investors would be able to invest into to gain that exposure to a wider range of assets or investments, shares, than they would able to individually without having a much, much larger amount of money to invest.
Yeah, so a professionally managed, well-diversified portfolio, really, and it offers you access to that.
So you're getting that portfolio in one place. So, for argument's sake, you invest £10,000, dollars, dirhams. That's only if you wanted to buy maybe 10 stocks. But if you were to invest that 10,000 into one mutual fund, you could potentially have exposure to, for example, the S&P 500. And you would get 500 stocks within that one investment.
Yeah. Okay.
It's a much cheaper, much more cost-effective way to access a wider range of investments, as you say, to get that diversification at a smaller, more manageable level for the individual investor.
And perhaps a more kind of not risk averse, but I mean, it kind of is risk averse, but
it's reducing your risk because of that diversification. Yeah. Because you, again, at that lower level of investment, it's very, very difficult to get an exposure to those wide range of companies, whereas that mutual fund allows you to do that at a smaller scale, so you get the diversification, but also access to those markets that you wouldn't be able to achieve otherwise.
Okay. Term that we hear a great deal, particularly in the UAE, in this region, I think, really, and we're all kind of aware of what it is, but how it works, I don't think we're all great at understanding. Ultra high net worth, high net worth. What does how would you define net worth, first of all?
Wow. Well, net worth is, that's a relatively easy one. That's when you're doing your balance sheet. So you've added up all the assets you have, your house, your bank accounts, your savings, whether you include things like cars, debatable, but they can be added if you have particularly valuable cars, jewelry, And if you had some nice diamond gold, obviously gold has been held as an investment now, as well as a piece of jewelry. So it's all of your assets minus any debts that you have. That gives you your net worth. That's the figure that you're currently worth in a monetary amount.
Okay. All right then.
So that's where net worth comes from. And then, as you rightly say, phrases I really do not like. Oh, I only deal with high net worth or ultra high net worth. Really not a phrase that I'm a fan of, because I think everyone deserves good financial advice, whether they are wherever they sit on that spectrum, because often I'm talking to someone who's starting out on that journey. Their net worth is effectively zero.
Yeah.
But should that mean that I don't talk to them?
Their net worth could be minus.
It could be minus.
Could be debts there. But, I mean, your argument is sound. Those are people that, require help, deserve help.
Yes.
Yeah.
But to answer the other parts, the high net worth and ultra high net worth are really just arbitrary amounts that are applied dependent upon what that net worth is. Typically, maybe high net worth, and again, this is above $1 million.
Right.
Ultra high net worth might be above, again, it very much depends on the institution that's applying them, but it might be 10 million, it might be 100 million. Different banks, different investment houses have different criteria. I seem to remember from studies it was typically 5 million and above. But is that still valid with inflation and how value has eroded? Arguable whether that's correct or not. But yes, it's just a measure of your wealth.
Yeah, a kind of tomato, isn't
yes.
it, really?
And some institutions will then, I'm not dealing with someone whose net worth is below X. Well, that's, I think, a very short-sighted approach, because you don't know until you've spoken to that person what their circumstances are.
Well, also, if you help the person that needs help and they become financially responsible and start to build, and
I've always been like yourself, we've known each other for 20 years, and we've built that relationship. If I'd have said to you 20 years, no, I'm not dealing with you, what? They just
did that cross your mind?
Never.
Are you telling me that crossed your mind? Like,
never. There's not
sure
one person that I've ever said that to, because it's, as I say, it's just one, it's rude, but I think, and just very short-sighted.
It's short-term thinking. Yeah, absolutely right. Okay, so that's net worth.
Yep.
Options. This is something you hear a lot. An option is an opportunity to do something. It's a path that you might or might not take, but in financial terms, a little bit different.
It is. But actually, is it? Options are simply that: options to buy and options to sell.
I suppose so. Yeah. Okay.
And again, another. I get. I would argue a more complicated and technical investment or position. Not something that the average investor will be necessarily taking involvement in. I was going to say advantage, but sometimes not. Because my concern often is, you hear this, it's a definite that X is going to fall in value. Then people will take an option that they believe that that's going to happen. So and again, it's placing a bet, which is why it is not carried out here in the region, because obviously it's against the local.
It's against Sharia principles.
Yeah,
right, yeah.
So therefore, it's not something that's transacted locally, or obviously now you can access to international markets, and so therefore you can still do that. But yes, so it's whether you think something's a sure bet that's going to go up, and you can take a position that an option on that share or that asset rising in value, and the same token if it's going to fall in value.
Right.
And sometimes people will then multiply that bet. So let's say 10 times they think it's going to go up, go down, but obviously, if you get the call right, brilliant. If you get it wrong, you can very, very quickly find yourself in a very deep hole.
And that's the reason for asking.
And that's the reason that, yes, and I see that's why it's on the list, and that's why it can become incredibly dangerous, because you're placing that position, and it is on the expectation that may happen. As we know in markets,
they go up, they
go down, and they go up and down, seemingly or often completely against what the market might think is going to happen. Interest rates are going to be cut. and they're cut, and the market reacts completely differently because maybe some other piece of information is released, inflation data, jobs data, all these different factors, earnings releases. Companies can produce amazing results, but it's not quite what the market thought that they would, and therefore their share price dives. So all these factors make it incredibly difficult to make these calls.
And the whole point of this is to try to understand, or to try to have
why
some foundation of knowledge as much as you can.
And I would argue, if you're getting to the point where you're looking into options, then you would know most of it. If you don't know what we're talking about, then it's something to steer clear of.
And we're talking personal finance on the programme now. Just a reminder to get in touch. info@mira.fm is the email address, and also whatsapp.mira.fm is straight through to the studio if you want to let us know what you think. We appreciate your comments, positive or negative. I'm easy. I've been told many things in my life, so I'm used to being told the bad stuff, but I do prefer the good stuff still. I'm still human, some would argue. James Thomas is here. He's an independent financial consultant. James, talking phrases. Let me ask you this quickly. Is there a phrase that you find yourself using in conversation?
Probably, and you're probably better placed to tell me what it is. People who are listening to you as opposed to listening to yourself. I'm sure there are.
Because years ago, I was working at a radio station, and somebody texted in and say, after every guest response, two presenters working on the show, one of you will say, absolutely, that kind of affirmative thing.
Yep.
So we decided, right, if we say that, we'll have a little jar in the studio.
Penny jar.
And every time we'll put, some money in that jar. And actually, it stopped me saying it. So I would never kind of listen to you, and I would agree with you about some things, and others things maybe not. But I never say absolutely. And it kind of trained it out of me, which I think was a good thing, because it's easy to fall back on, trite sort of phrases when you're talking to somebody, you're listening to somebody, and you're trying to be ingratiating. Is there a particular phrase that you find yourself using, do you think? I can't think of anything off the top of my head.
Well, that's good to know. Absolutely is one that springs to mind. I do like that.
That's a popular one.
It is popular. Again, I'd have to do a little poll of some of my
Again
clients.
is something you do say,
Okay.
actually. Yeah, that's
right.
a James quirk, I think. You'll say, you'll be in a conversation, you'll take a breath and you'll be like, again, this is it, and that's kind of your linking phrase. Maybe that's one.
There you go.
It's not a bad thing. I'm just interested in these things. Strangely enough, I listen to what you say. Who knows why?
Hopefully it's interesting.
I'll have a pee, please, because that's where we are. Portfolio is where we're at. What is, in financial terms, what's a portfolio?
We're going back to net worth. It's one part of that net worth. So your portfolio, I would argue, is the liquid assets. So again, going back to the mutual funds, the stocks and shares, the bonds, the cash. It's the things that could be relatively easily sold, as opposed to, having then said that, I'm going to contradict myself, I was going to exclude property if it's your home. But of course, people nowadays will potentially buy a portfolio of properties.
Sure.
But that's as an investment as opposed to their home.
Right.
So it's a collection of assets that you have built to become a portfolio. Rather than one, many would become your portfolio.
So you would put in that your bank account or accounts,
Yes.
your stocks, any bonds you may own, mutual funds.
Mutual funds, all of that would become your pension, because obviously within the pension would have all of those things typically. But yes.
But a home, even though a home is clearly an investment, you wouldn't necessarily put that in. It wouldn't be a portfolio kind of pillar,
I personally wouldn't include it if it was the one property that you owned.
Right.
If you had more than 1, 2, 3, 4, 10, some people have got many more than that, then that becomes a portfolio in its own right.
Okay.
Because it's then a collection of assets that happen to be property, as opposed to the one that becomes your home. Because while, yes, it is an investment, I would argue it's not its primary function as to be an investment. It's to be your place of where you live, your home.
Gotcha. Fair enough. That's a portfolio. We're up to R in the alphabet that we're trying to demystify when it comes to financial terms. Refinancing. Hear it a lot. What does it mean?
Again, going back to that mortgage analysis question. refinancing is simply taking debt that you already have, going back either to the same institution or another one to make the terms better, be that a lower interest rate or a shorter term, or of course sometimes it could be that you actually need more money.
Sure.
So if the asset has increased, going to the property and investment has increased in value, and you want to release or need to release some equity, then you go to that institution and say, right, it was worth X, it's now worth plus 20%. Can I take half of that and refinance, repackage my debt?
Sure, repackaging is a good way to phrase it. We need to jump back to C, actually, because refinancing could also be a way of consolidating.
It could be a way of consolidating, yes.
That's worth pointing out.
Yep. Often, and again, I'm hesitant to recommend it, but certainly as a practical way, if you have other forms of debt, i.e. credit card or personal loans at a much higher interest rate, then a way to refinance that, if you did have a property that's increased in value, is to take an additional amount from your mortgage, which then will reduce the loan amount, reduce the interest amount. But going back to when we were talking about mortgages, just be conscious that while it may reduce the monthly amount, it's because you've extended the term, and therefore you could still end up paying more.
For sure.
So it's not a straightforward scenario, but it's one that you should, again, like all of these things, look into in detail.
Yeah, on balance, does it make your life easier?
Yes.
Does it give you some breathing space?
Yes.
Does it, relieve the pressure
If
slightly?
that's the case, then great.
Okay.
But just be conscious you may still end up paying more for that debt.
Okay, let's
than you
fast
would have
forward from consolidation back to refinancing,
Yep.
back to the next one. Then this one I think you like, because really at the heart of everything you do as a financial consultant, as a financial advisor, is planning. And I guess, the retirement plan is a pretty important part of that.
Absolutely
it's kind
essential.
of everything, isn't it?
Yes, I'm hesitant to say yes because again, as we've discussed in previous shows, life insurance and critical illness is the foundation. But once you've got that foundation to build upon that, yes, the retirement plan, the savings plan is the next, absolutely critical part. That's the seed. That's the planting of the little seeds from small acorns do great
oaks
tree grow. Yes,
yeah, quite right.
Albeit at a very slow pace. So maybe you want a faster growing tree, a fir or a whatever it might be. My horticulture's letting me down.
That's
but,
what you need compost for.
Absolutely.
Compost interest. That should be a thing, shouldn't it?
But that's again another analogy of what the compound interest is doing. It's like putting that compost on your garden, making it grow, making it increase.
It's much more colourful than I thought this. There was an interesting point. Some of these terms I got from a website called Coursera.org, which is looks at financial courses and offers, experiences to do with planning for finances. But it came up with an interesting thing here. A retirement plan is a financial strategy for setting aside money to be used in your golden years. So when, you leave the world of work, if you like. Think of it, and I kind of like this, and I think you will as well. Think of it as planning an epic vacation. It's an American site. But one that lasts several decades, or for
again,
hopefully
dare
a long
I
time.
say to talk salesy for a second, when we're discussing retirement planning, savings planning with prospects and clients.
Yes.
Say, right, you working at the moment? Yes. Could you imagine not working for a year? Maybe.
I'm with you.
How would you cope? Well, it'd be potentially quite difficult at the moment.
Well, I can tell you it is difficult because I got ill a few years ago, as you know, and really had to sort of pull back on the work, and it does get tough. Yeah.
So then the next question: what if it was 5 years? And then what if it was forever? If you were never going to work again?
The reason
again, it's just to get it's a train of thought or questioning to get people to realise what retirement is.
Yes.
And if you draw it as a graph, your salary, you would hope as you get promoted, as you get pay rises, it's generally an upward trend.
Hopefully, yeah. absolutely.
hopefully.
Right. Yeah.
But then you reach whatever that date is, and again, that's part of the discussion. When you want to finally stop, is it 55? Is it 60? Is it 65? Is it 70? Whatever that date is, that you say, had enough, halas, I'm stopping working. But then, of course, the line that has merrily ticked up for all those years crashes back down to zero. And this is when your retirement plan steps in as your income replacement.
Well, that's why I left retirement plan in, because retirement plan is not something that really needs explaining. A retirement plan is a retirement plan. On the face of it, for all of these terms that we've talked about, there is a little bit of demystification kind of needed to understand what an option is, for example, or
Yes.
a bond.
Yes.
A
They're not
definition.
the most everyday technical.
They're not everyday
they are a
technical.
more technical term.
Yeah. If I said to you, what's your retirement plan? Some people would explain it. Some people would be, well, I haven't got one. But the point is to make it clear that you should have one. You need a strategy.
You need to have a strategy, and because most people think, not most people, a lot of people just have this view that it's sometime way off in the distant future, and things will just happen.
Yeah.
And of course, the reality is, unless you do put a strategy in place, it will not happen. Time, as we've discussed, and they sound like the two grumpy old men in the Muppets, sitting up on our balcony. But if you're not careful, well, indeed, it will happen.
The time has a way of catching you
careful
up.
is not a point at all. It will happen. Time
goes by.
in a click of a finger, we're already in mid-November, so that's 11 and a half months of this year gone. Only seems like yesterday we're all celebrating the new year. The next one is only 6-7 weeks away. My point being is, if you don't put that plan in place, that time, again, another way to try and illustrate, 10 years is 120 months. It's 100 average, normal, if you're paid normally, it's 120 paydays.
Yeah, okay.
It's just all these different concepts.
Much, is it, when you think
not
about it?
that
No,
much.
That's a good point.
So 20 years is 240. So you've got 240 opportunities to save some money, to build a lump sum for your future.
Clever man that I know, who knows his cliches and loves a meme as well, said to me years ago, fail to plan to fail. And I thought, cheesy, but really, it's true.
Again, why maybe it does sound cheesy, but it's just trying to find different ways to connect with people, to make them realise that this, what seemingly is a very cold, dull, uninteresting subject matter, is one of the most important things that people need to be aware of, because another cheesy line, wish we didn't get old, but what the alternative is even worse. Enjoy it, but make sure that you've put something in place to make sure that it is enjoyable.
Okay, and it's your choice to do so,
yes,
of course.
Of course.
All right then. Stock. How would you define a stock? How many have we got left? 1, 2. Oh, we've only got 4 left. Let's try and get these done before.
Stock, short and simple, is another word for asset or share. It's a thing that trades on a market.
Ownership in a corporation as well.
Corporation.
Yeah, it's a little bit of a corporation's assets and earnings. Yeah.
Yep.
A tiny slice of a big company pie. Somebody said about a stock. Stock market. What's the stock market? How would you define a stock market?
Where those things are listed, where you can actually access to purchase them.
Short and sweet. There you go. Where a company's list and you can take part. A phrase that we hear a lot in financial terms is volatility, and it's used so widely.
It is.
What does it mean?
How much something moves up and down in value.
Okay.
So if it ticks up, and a bank account has very low volatility because it just goes up or doesn't go anywhere, but it's flat.
It's just there.
It's just there.
Right.
You put a pound, dollar, dirham in there, tomorrow it will be the same amount is there. Mm-hmm. Whereas if you were to buy one of those shares, those stocks, It could go up, could go down. Cryptocurrency is a great example, perhaps, of most volatile, because you can see the prices moving a huge amount. So the more it moves each day or each period of time is how much more volatile something is.
I just think if you look at financial graphs, and I'm not telling people to go and look at financial graphs because it's not the funnest thing, but if you do look at a financial graph, if you look at the graph and it's going straight horizontally across the page, that's low volatility.
Completely zero volatility. Yes.
Okay. If it's going, like an EEG, if it's moving like a nicely relaxed wave, little bit of volatility. If it's spiking up and down like a, I don't know, person at a Motorhead concert, I can't think, a headbanger. Best I could come up with at short notice. That's true volatility.
That's true volatility, exactly. So it's the movement, technically, is the movement of something that goes up or down over a period of time. And as you rightly say, something that's very flat and benign, low volatility.
Yeah.
If it's jumping around like a
high volatility.
High volatility.
All right. The final thing on here, I mean, there were loads of different things that we could have discussed in this segment, but the last thing is yield. How would you define yield? Because it is a term, people talk about this in particular when it comes to property. People talk about property yields.
Yes.
And a lot of people do it without really understanding what a yield is, I would guess. I'd hazard a guess in some cases.
Yeah, I mean, a yield applies, as you rightly say, property, to those stocks, to bonds. So it's if we look at property, generally it's the rent or the income that it generates from a tenant occupying that on your behalf.
Yeah. Typically usually expressed as a percentage, isn't it?
It's a percentage.
It's a percentage
So,
yield, yeah.
I don't know. Again, London maybe would have a lower yield because it's a very well-established property market. As an example, perhaps somewhere outside of London, while the property itself might be a lower cost, but it might have a higher yield, as an example.
Right, okay.
But it's the yield, it's the revenue that it generates. And often it can be referred to as net. So after all the costs that you've had to pay out to run that property on behalf of the tenant.
Right, okay.
Maintenance fees, service fees, etc. When we're looking at a share, it's typically the dividend that's payable. So this is a share of the profits that that company has made, and because obviously, not obviously, but taking a step back, what is a stock? It's your, as you write description before, it's your share, your fractional ownership, if you like, your partial ownership of that company. And in return for that, not only are you getting the increase, hopefully, in the value of that company, if the company is making a profit, then it will pay a dividend, so a share of that profit to each of the shareholders. So if you own some shares, you will get a proportional amount of that profit.
Okay. Fair enough. It's a measure of investment performance yield, isn't it?
It can be.
Yeah.
And again, but just to go back to the share example, typically what we would call a growth stock, perhaps opening up a whole new range of descriptions, but the tech stocks, as an example, typically are growth stocks, and often they're newer companies and don't generally pay dividends. So you're investing in them purely for the growth of that share price. Yeah. As they mature and become more well-established companies, they typically then start to have more consistent profits. They're not reinvesting into the business. Yes. They then will start to pay out a dividend. So you're investing in them purely for the growth of that share price. Yeah. As they mature and become more well-established companies, they typically then start to have more consistent profits. They're not reinvesting into the business. Yes. They then will start to pay out a dividend, a yield. So it's not necessarily, so the yield might still be low, but there's still a lot of growth that the share itself is generating.
Okay.
But the older that company is, and perhaps the more established it is, typically the yield will become higher. Again, very broad brush.
We've gone from 401k in American term, assets, asset allocation bonds, all the way through to yield, trying to demystify and kind of define and discuss some of the financial terms that you get bandied around that maybe we're not all absolutely au fait with, because there are
Hopefully
times
we
when I
managed
think,
it.
I don't know what this guy's talking about, but I'm a little bit too embarrassed to say. And of course, you should always ask the questions.
Always, always, always ask the question.
That's really important. James Thomas is an independent financial consultant with us Thursday mornings here on Mira Business FM. And as always, James, appreciate it. Thank you.
Oh, thank you.
Good to see you. Mira Business FM.